Hi guys, welcome back to Swera Education. We have discussed earlier how to analyze shares and invest intelligently for optimal outcome in previous series of videos on share market investment. Today we are going to cover another method of investment which many of us hear a lot. Yes, it's mutual funds. We hear mutual funds are subject to market risk. Is it so? In today's video, we will cover some basic concepts of mutual fund and touch upon few queries which many of us would have regarding mutual fund investment. Overall, we will be covering these points in our videos today. What is mutual fund? What are various types of mutual funds? What are various investment strategies in mutual funds? How to choose a mutual fund? How much return we can expect from mutual fund investment? What are tax implications of mutual fund investment? What are the procedure of starting investing? Coming to the first point, what is mutual fund? Mutual funds are indirect way of investing your money in shares, gold, bonds, fixed deposits, etc. There are various fund managers who are well experienced than us in investment market who manage particular mutual fund and in scale of hundreds and thousands of crores. Based on type of mutual funds, they invest the money in equity or shares of various companies, fixed deposits of various financial service providers, corporate bonds and government bonds, etc. We will discuss these in more detail when we cover various types of mutual funds. So, retail investors like you, me, we can buy small units of these mutual funds based on our goal, and instead of buying a full share of a company or buying a full gram of gold, we'll be investing a small part of it in per unit. Investing in mutual fund will give you confidence, knowledge and flexibility when you are entering the investment market. Now, what are the types of mutual funds? First, equity mutual funds, which invest your money in equity market or share market by distributing it across various companies. There are subtypes as well, which are large cap equity, which invest in big companies such as, let's say, top 100 companies, mid cap companies which are from ranked 100 to 250 in terms of volume, and small cap company below 250. Large cap mutual funds are low risk because it invests in established big companies. Mid cap has moderate risk and small cap has high risk. Hence, the average return of those various mutual funds, large cap, mid cap and small cap, it also varies. Second type comes debt mutual fund. These are like fixed deposits. They invest in FDs, government bonds, institutions, etc., where the risk is very less. So the returns also becomes very less compared to other type of mutual funds. Thirdly, hybrid mutual funds, which invest in both equity and debt. You can have a balance between the risk and returns. It can be aggressive hybrid where your investment percentage is more towards the equity, or it can be conservative hybrid as well where the percentage of investment is more towards the debt fund. You can select among all these type of mutual funds based on your goal, like for how long you want to invest your money and for what purpose in future. There are also tax saving mutual funds or ELSS, which is called equity linked savings schemes, in which you can save tax up to 1.5 lakhs of investment. It comes under 80C and it has a lock-in period of 3 years, which means you cannot withdraw money for 3 years. There is also something called index funds. Basically, if you are a beginner and don't want to directly jump into share market, you can invest in index funds. It's like investing in Sensex or Nifty, which are defined by top performing shares, and it generally keeps growing. There are various different index funds which many fund house manages. You can compare those and invest in. The return is not as high as equity, but comparatively it is good and has lesser risk. Like share price of a stock, any mutual fund has NAV or net asset value, which defines price of one unit of that mutual fund. It can go up or go down, mostly when it is based on equity, because as per the market fluctuation, the NAV value also will fluctuate. Coming to our third point, there are basically two kinds of investment methods in mutual funds. One is lump sum, another is SIP. In lump sum investment, you invest a fixed amount, let's say 50k in mutual fund, and buy the units at the NAV price at that time. Based on market and the time you give, your investment value will grow. SIP or systematic investment plan is putting small amount of money periodically in a mutual fund, monthly or half monthly, let's say 1000 rupees every month. So every month the units bought will vary as per the market and the NAV value of that month. In general, it is advised to invest in SIP, especially when you are choosing equity based mutual funds, because it will average out the risk of a share market fluctuation and it will give overall good returns in longer period of time. So while investing in long term and equity market, it's advised to invest via SIP. For debt mutual fund, for short term gains, you can invest in lump sum in any good debt mutual fund. Next, how to choose a mutual fund. You can go to any online website and search for top performing mutual funds in various categories. You can check the CRISIL rank for a mutual fund. If it is good, you can see its portfolio, that is, in which all sectors and companies it is investing money. You should also see how well that mutual fund has performed in last 3 years or 5 years or so, just like share market. Based on CRISIL ranking, returns and portfolio, you can shortlist the mutual fund you want to invest in. There is another factor called expense ratio, which is the amount per 100 rupees which goes to managing that mutual fund. It generally varies from 1% to 2.5%. The lesser the expense ratio, the more profit you will have in the end. Also, there is exit load, which varies for various service providers and varies as per duration of investment. So you can check this and select the funds which have lesser exit loads. Now, how much returns we can expect for mutual fund investment? It varies with the type of mutual fund as well as the period of investment. We will compare various types with an average return and you can select based on your goals. For 1 lakh lump sum investment, the returns after various time frames will be. So generally people don't invest in debt fund for a very long duration. So these are some outputs considering average interest returns from various top ranked mutual funds in all these categories. So clearly it depends on your goal and how you want to invest in. Based on that, you will earn different amount. Many people also diversify their portfolio across combination of types of mutual funds to balance out the risk and to get decent returns. Now let's discuss tax implications of various types of mutual funds. When you're investing in equity or hybrid, where partially or fully the amount is invested in equity market or share market, the tax is computed same as the stocks. That is, the profit you earn by selling mutual funds is considered as capital gain. If you sell within 1 year of buying mutual fund, the profit amount is considered as short-term capital gain, or else it is long-term capital gain. For short-term capital gain, tax computed is 15% and for long-term it is 10%. Also, if your profit is under 1 lakh rupees, you need not pay any tax. So for equity or hybrid mutual fund, it is beneficiary to hold it for more than 1 year. In fact, it's better to hold it for 5 to 7 years. But if you're investing in debt mutual fund, whatever income you get from profit, it gets added to your net income. And as per your income slab, you have to pay the tax on that profit. So basically, it's counted as income from other sources in tax calculation. So what's the procedure to buy or invest in mutual funds? Basically, it can be done in 2 ways. Number 1, via agents, where agents will invest your money, so you have to pay the commission and obviously your investment amount will reduce. And second is direct funds, which you can buy via various few apps online which are commission free or directly from specific mutual fund provider online. Here you don't have to pay any commission value, only the expense ratio of that particular fund you need to look out for. I personally use Coin by Zerodha, which is completely free and they don't charge any single penny for buying or selling a mutual fund. There is exit load up to 1%, which varies for different mutual funds as well. Again, if you keep invested for more than 365 days or 1 year, the exit load is nil and it's the charge for the fund house for premature exit. So basically, if you are someone who does not want to invest all your money in share market or gold or real estate, but in the same time you don't want more risk but not as low returns as fixed deposits, it's better to start investing in mutual funds, where you have an amazing flexibility of choosing funds as per your own convenience and goals. And we have shared what all small details you need to check before selecting any mutual fund. So go ahead and start investing. If you like this video, please like and share among your peers. Also, do not forget to subscribe to our channel to learn more on various other aspects. Thank you again and see you soon.